Okay, let's unpack this. Today, we're doing a deep dive into the Kenyan financial and business markets. We're looking at the latest movements, the trends, basically everything coming out of reports and company results for May 28th, 2025. We've got a whole stack here, daily market watches, some analyst insights, company earnings, from firms like AIB, AXYS, Africa, plus news sources covering the financial highlights. And our mission really is to cut through all that data. We want to pull out the most important nuggets for you, understand the day's market action, what's driving key companies, the bigger macro picture, and what the analysts are actually saying right now. So let's kick off with the overall market picture for today. What did the numbers tell us? Well, look at the market summary. Equity turnover, that's the total value of shares traded, saw a really significant increase. Jumped to KES 481.42 million. That's up 130.6% from the last session. Pretty big jump. And the total market cap, so the value of all listed companies, also rose slightly, up 1.1% to KES 2,109.77 billion.
Yeah, what's fascinating there is just how much activity that turnover figure shows. 113.6% jump. That signals way more trading volume today. And that rise in market cap, even if it seems modest at 1.1%, it still means the overall market value grew. So definitely some positive movement.
Right, and the indices reflected that too, mostly positive momentum. The Nairobi All-Share Index, the NASI, which gives that broad view, it ticked up 1.1%, closed at a 134.12. And the NSE 10, NSE 20, NSE 25, tracking those larger or more liquid stocks, they also saw gains, sort of between 0.4% and 0.5%. Modest, but up.
And a bullish NASI like that moving upwards, it usually suggests positive sentiment overall. The source material actually highlights that this gain was primarily, and I quote, supported by gains in large cap stocks. So the biggest companies were really pulling the weight today.
Okay, so if large caps were the main drivers, let's drill down into those equities. Who were the specific winners and, well, the losers today? Looking at a top gainers list from the sources, Standard Group climbed 9.2%. That's quite a move. Samir Africa was up 7.5%. Centum Investments and Sanlam Kenya both gained 3.6%, and Olympia Capital Holdings saw a 3.5% increase. And then on the flip side, the top losers, East African Cables dropped a sharp 9.0%, Express Kenya down 8.8%, TPS Eastern Africa fell 7.7%, and then both eGas, Paycheck, and Home Africa were down 3.1%. So quite a spread there.
It absolutely is a spread. It shows that while the overall NASI went up, it wasn't an across-the-board rally, and the source confirms that the positive momentum came specifically from those gains in large-cap stocks. The key names mentioned driving things were Safaricom, up 3.0%, Diamond Trust Bank, DKB, that gained 2.9%, KCB Group up 1.2%, and I&M Group increased by 0.6%. So these heavyweights were really lifting the index.
Got it. And the report also points out stocks that actually weighed things down despite the overall gain. Those included East African Breweries, which dropped 2.7%. HF Group was down 2.3%. BK Group lost 1.3%. And Jubilee Holdings was down 0.9%.
So you see, it's a really nuanced picture, isn't it? You had strength in those key large caps, enough to pull the whole index up. But at the same time, several other pretty significant companies saw their prices fall. Which, raises that important question. What's actually going on inside these specific companies or sectors to cause such different performances?
Exactly. So let's zoom in on that. What do the sources tell us about individual companies? Especially those with recent results are getting analyst attention. The banking sector features heavily today. The analysts, they seem to expect increased appetite in banking stocks by investors. Basically, as banks keep reporting their earnings this week, investors might be key to buy in, hoping for, potential capital gains. Price increases, and we have several Q1 2025 results highlighted right here. Let's start with Absa Bank Kenya. Their profit after tax grew 3.6% to $6.1 billion in Q1. The source says this was riding on cost cutting, specifically cuts in interest paid out, lower loan loss provisions, that's money set aside for potential bad loans, and managing staff costs. So efficiency driving profit.
Interesting. And then you have I&M Group. They saw much stronger profit growth, actually, up 18.1% to $3.9 billion. And what really boosted them, according to the source, was strong performances by its regional subsidiaries, their businesses outside Kenya. These regional operations contributed a significant 26% of the group's profits. The regional CEO even said their diversification strategy is bearing fruit, so that geographical spread is paying off for them.
Yeah, that's a clear diversification win. Then there's HF Group. They also reported a big jump in net profit, up 2.2 times to $327.93 million. Driven by more interest income of 14.6% and also non-interest income like fees of 9.9%. Their CEO puts this down to their transformation and diversification strategy. They're highlighting growth in business banking, property,
Yeah.
custodial services.
So another example where diversification seems key.
Definitely. And Diamond Trust Bank, DTB. The Q1 25 highlights are noted too. Net profit up 9.9% year-on-year, reaching KES $3.23 billion. Net interest income rose 8.0%. Assets grew 4.1%. Loans up 5.7%. Deposits up a healthy 9.0%. And earnings per share EPS, that was also up 8.7%.
Solid numbers across the board there.
Yeah, and the AIB AXYS Daily Whisper source, they give DTB a BUY recommendation. They see an implied upside potential gain of 21.4%. That's based on their target price of KES 183.06 versus the current price around 150.75. So analysts are positive there.
Right. Now, NCBA Group, their earnings note gives us a deeper look. They had more modest growth, 3.4% net earnings growth in Q1, reaching KES $5.48 billion. The source says this was mainly driven by a strong 20.6% jump in net interest income.
Okay, how did that happen with only modest profit growth?
Well, interestingly, it benefited from a sharp drop in their deposit expenses. This happened because customer deposits actually declined. So they had less pressure, on what they had to pay to attract or keep those funds. Their net interest margin, the profitability spread, expanded just slightly 10 basis points to 5.8%.
Ah, okay, less deposit cost pressure helped the margin.
Exactly. But here's where it gets more nuanced within CBA. The source notes their asset quality, the health of their loan book is under pressure. Now, the actual amount of gross non-performing loans, the bad loans, it went down. But the gross NPL ratio, which compares those bad loans to the total loan book, that ratio actually rose to 12.6%. That happened because the overall loan book shrank. So the bad loans didn't shrink proportionally as much as the good loans did.
Okay, so the proportion of bad loans increased even if the absolute number fell slightly. What are they doing about that?
Well, the source notes management increased their NPL coverage. They set aside more money to cover potential losses. That signals caution. And they're actively contracting their loan book. It was down 10.4% year on year. They're lending less.
So where's the money going instead?
Into government securities. Their allocation to government bonds and T-bills is up 4.6%. The source explicitly says this is to leverage the attractive yields offered by these lower-risk instruments. They see government debt as safer and offering good returns right now compared to, say, business loans.
That's a very clear strategic shift toward safety.
Definitely. And one other point on NCBA, their non-funded income, things like fees and trading, that declined. Specifically, foreign exchange trading income dropped almost 50%. A big hit.
Wow. Is that just them?
No, the source says it's a trend consistent across the industry. So less currency volatility maybe, leading to fewer trading opportunities for banks generally.
Okay. What's the outlook for NCBA then?
The source suggests interest income might actually decline if market rates fall, but their net interest margin could stay stable if their funding costs fall even faster. They expect the cautious lending and the shift to government securities to continue.
Yeah.
And they also highlight the new NCBA insurance unit, their bank assurance arm, calling it a new and diversified revenue stream. So again, diversification.
Right. And the analyst recommendation, AIB AXYS Africa maintains a BUY on NCBA. Their one-year target is KES 58.15, which implies about a 7.1% upside from the current price of 54.30. They also note the valuation trading at a price-earnings ratio of 4.1x and price book of 0.8x, so relatively low multiples.
Yeah, suggesting it might be undervalued based on those metrics.
Okay, let's move beyond banking for a minute. The Daily Whispers had calls on other stocks too, other counters. Bade Kenya got a BUY recommendation. The reasons given. A progressive dividend policy, they tend to raise dividends. Also, stabilizing cost pressures are likely to raise gross margins, and they think the ex-dividend price offers an attractive entry point.
So dividends, costs improving, and a potential buying opportunity after the dividend payout.
Exactly, implying a pretty significant 24.8% upside to their target of KES 436.25. East African Breweries, EBL, also got a BUY. Rationale there. Resilient demand levels across its portfolio brand offerings. People are still buying their drinks. And nimbler growth across subsidiaries expected to support steady long-term revenue realization.
Sound like stable demand and growth potential from subsidiaries.
Yep. The implied upside is more modest, though, 5.4% to a target of KES 185.00.
Still positive, but less dramatic than bait.
Right. Now, on the other side, Nation Media Group Pelix received a sell recommendation. The reasons. Ongoing losses clouds investor dividend prospects, so losses mean no dividends likely soon. Also, print media sales drop as consumer habits change, and rising competition from new players. pretty clear challenges.
Yeah, that paints a tough picture for traditional media there.
It does, and it implies a significant potential downside of 20.8% to their target price of KES 11.4.
Ouch.
Finally, Stanbic Holdings. He had a hold recommendation. So analysts think it's likely to stay fairly stable. The rationale mentioned Stanbic is expected to capitalize on its improving asset quality to support the expansion of its loan portfolio, and also that strategic expansion efforts are anticipated to enhance core banking performance.
So improving loan quality and expansion plans are positives, but maybe not enough for a full BUY yet.
Seems like it. The implied upside is 13.5% to their target of KES 210.05. Decent potential, but maybe priced about right for now, in their view.
So looking across all those analyst calls, you really see a range, don't you? From strong BUYs like BAT and DTB to holdies like Stanbic and even a sell on Nation Media. And crucially, these aren't just gut feelings. They're tied explicitly to things the analysts are watching. Earnings drivers, cost control, diversification success, asset quality trends, dividend policies, competitive pressures. It's all about the company specifics.
Absolutely. Okay, let's shift focus slightly. Who is actually doing the trading today? The report has a participation mix. It shows local investors were responsible for 55.5% of the trading volume, and foreign investors made up the other 44.5%.
Okay, nearly half foreign. But here's the key thing connecting that to market flows. Today saw a really significant change from the previous session regarding foreign activity. Foreign investors were net sellers. They sold more shares than they bought, with total outflows hitting KES 178.30 million.
Wow, that's a big outflow. How does that compare?
Well, it's a sharp reversal from yesterday, which actually recorded KES 36.55 million in net inflows. So going from foreigners buying on balance to foreigners selling quite heavily on balance. That's a key observation for today.
Where were they selling most actively? The top foreigner sales list shows Safaricom saw the biggest foreign selling KES 110.22 million worth, followed by ABSA Kenya at KES 92.65 million and Equity Group at KES 82.35 million.
Yeah.
So big names seeing outflows.
But they were also buying some of those same names, right?
Yes, exactly. Their top buys included Safaricom, again KES 61.33 million, and Equity Group KES 60.57 million. They also bought Cooperative Bank, KCB Group, and Standard Chartered Kenya, but in much smaller amounts.
So Safaricom and Equity showing up big on both the buy and sell lists. It means foreigners were trading these stocks very actively today, lots of shares changing hands. But the net result, the overall balance, was significant selling from that foreign investor group. That definitely put some context around the day's price movements.
Okay, stepping back from the pure stock market action, what else did the sources cover? Anything giving us that broader business environment picture? Well, the today's news highlights section mentioned a couple of interesting things, particularly some proposals coming from the World Bank. The report mentions the World Bank suggesting an increase in the top rate of income tax. They propose 38% for people earning over SH 800,000 a month.
Okay, that's higher than the current top rate.
It is. Currently, it's 32.5% over H 500K and 35% over H 800K. But they pair this proposal with reducing the tax burden for mid- and low-income earners, those below SH 166,677 a month. The source says the stated aim is to potentially boost the formal economy. It involves a new tax band and maybe getting rid of the 30% rate.
So a potential restructuring of income tax brackets.
Seems like it. And there's another World Bank recommendation reported. They suggested exempting workers who earn less than age 32,333 a month from the housing tax and the new social health insurance fund, SHI. Again, the stated goal mentioned in the source is to boost disposable income for those lower earners.
And the source mentions those levies have been felt.
Yes. The report notes these levies have impacted take-home pay and also increased staff costs for employers.
Right. And just to be very clear here, we're reporting strictly on what the source says about these World Bank proposals. The report presents them as suggestions with specific intended outcomes, like easing pressure on low earners or boosting the formal economy. We're just conveying that information as presented in the source material, not endorsing or analyzing the policies beyond what's reported there.
Exactly. Maintaining neutrality. Just reporting the content. Okay, moving on to other market segments covered. Fixed income. Bonds. Secondary bond market turnover trading of existing bonds actually decreased today, down 23.2%. The highest value traded was in the FXD 112-112-15 YR bond, and the most frequently traded was the IFB 122-14-1 YRR.
Less activity in bonds today, then.
Seems so. Though the overall bond index did tick up slightly by 0.1%. Looking at key interest rates, the 91-day T-bill rate edged down a tiny bit, 5 basis points. The 182-day rate also down slightly, 1 basis point. The 364-day rate was flat,
So short-term government yields mostly stable, maybe easing slightly.
And the interbank rate, what banks charge each other, that saw a big decrease, down 336 basis points, settling at 9.80%.
That significant drop in the interbank rate could suggest improved liquidity in the banking system today. And remember, these rates, T-bills, interbank, they reflect liquidity and monetary policy sentiment, which definitely influences investment decisions across stocks, bonds, and deposits.
Good point. What about exchange rates? The Kenyan shilling weakened slightly against the US dollar today. You needed a bit more shilling to buy 1 USD, but it actually strengthened against the euro, the sterling pound, Japanese yen, Chinese yuan, South African rand, and the Ugandan and Tanzanian shillings.
So a mixed picture for the shilling.
Yeah, the specific rates listed were USD at 129.29, euro 146.co, sterling 174.11, and so on.
And currency movements, whether stability or volatility, they matter for investors, right? Especially those dealing internationally or considering those foreign flows we talked about.
Definitely. And finally, the derivatives market. Saw a pickup in activity compared to yesterday. Volume went from 0 contracts to 6, value traded went from 0 to 110,050, and the number of open interest contracts also increased slightly. So, a bit more action there.
Okay, so a bit of life returning to the derivative side.
So that's a lot of information we've covered. The market up overall, but driven by specifics. Company earnings showing different strategies, foreign investors selling, potential policy shifts, bond market quietening, currency moves. Pulling it all together, what does this really mean for you, the listener, trying to make sense of the Kenyan market based on today's snapshot?
Well, this is where it gets really interesting. If we just stick to the observations and rationales within these reports we've discussed, we can actually pull out some practical themes or insights that analysts are highlighting. Take diversification. We saw I&M explicitly state their regional diversification strategy is bearing fruit. And the NCBA Outlook pointed to their new bank assurance arm as a new and diversified revenue stream. So the sources themselves are suggesting that diversification, whether geographical or by business line, is a relevant and seemingly successful strategy in this environment.
That's a clear takeaway from the company specifics. What else?
Risk management and asset allocation. Look at NCBA again. Their deliberate choice to shrink the loan book, which they perceive as higher risk right now, and pump more money into government securities, seen as lower risk with attractive yields. That's a textbook example of risk mitigation reported in the source. It shows a conscious shift based on perceived credit risk and the returns available in safer assets.
So managing risk by changing where they put their money.
Precisely. And then there are the company-specific factors highlighted by the analyst recommendations themselves. The buy, hold, sell ratings weren't random. They came with specific reasons. These reasons are the practical things investors might consider according to these analysts. We heard about looking at dividend policy, like with BAT. Assessing cost pressures, also BAT. Evaluating asset quality, which came up for DTB, Stanbic, and NCBA. The importance of diversified revenue streams, mentioned for DTB and NCBA's insurance arms. Checking demand levels for products like EABL. Understanding changing consumer habits and competition, which was key for Nation Media Group's sell rating. Identifying the core earnings drivers, was it cost cuts like Absa, regional growth like I&M, or the income mix like HF Group. And even looking at valuation metrics like PE and PB for NCBA. These are all concrete factors pulled directly from the analyst rationales in the sources.
So the reports are giving you the checklist the analysts themselves are using.
In a way, yes. And finally, there are the broader market trends noted. That observation about increased investor interest in banking stocks due to earnings season and hopes for capital gains. That's a specific trend highlighted by the analysts right now. And the point about the industry-wide decline in foreign exchange trading income. That's another relevant trend for anyone evaluating financial institutions, derived straight from the source analysis.
That really crystallizes it. These aren't just abstract points. They are the specific details and trends the analysts and reports are honing in on right now, drawn directly from today's source material for you, the listener. Okay, so as we wrap up this deep dive for May 28th, 2025, we've seen the market indexes turn bullish today, but really driven by a few large cap stocks. We've explored the contrasting results and strategies of key companies, particularly in the banking sector. We noted that significant net selling by foreign investors today, and we touched on those influential policy proposals from the World Bank alongside the latest movements in the fixed income and currency markets. It's been a busy day to analyze.
It really has. And it leaves us with a final provocative thought, maybe. building on all this,
You
this
know,
raises an important question for you to consider as you watch these trends. How might those potential tax policy changes suggested by the World Bank aimed at shifting the burden between income levels? How might they intersect with the corporate strategies we observe today? Things like banks focusing heavily on cost cutting or shifting assets towards lower risk government debt. Could these policy ideas influence or interact with those corporate decisions and shape the market environment in Kenya over the coming months? It's definitely something worth mulling over as you continue to follow these developments.
that's a great question to leave our listeners with. A very thought-provoking point indeed. Thank you, everyone, for joining us for this deep dive today. If you found this exploration valuable and you want more deep dives into complex topics like this one, please make sure you subscribe to the show wherever you get your podcasts. And hey, stay connected. Follow the channel on social media. You can find the links right there in the podcast description. It's the best way to stay informed.